everyone, good morning. Let's start with our today's topic quickly. I know very few people have joined today because the reason is anyways you are going to get the recordings. Few people might have not seen the recordings of previous days. So no worries, we'll start with our next topic, that is gain and losses. Okay, so what do you mean by gain and losses? In capital gain topics we have already seen in the class. All the gains and losses should be allocated based on the types of property. Okay, whether it's a capital asset, whether it's any other asset, it will be allocated accordingly. So first of all, to understand that how much gain you are going to allocate, what is the formula? Selling price minus cost basis. Okay, so what do you mean by this cost basis? It is allocated into three different categories. One is purchase price. Okay, so what do you mean by the purchase price? The basis, whenever you are going to purchase any asset, you are always going to take the basis is equals to amount paid to acquire the property. So whatever price you have paid to acquire the property, take all the amount plus add all costs which is incurred to bring that property into existence, right? All the incidental charges, all the sales tax will also be added, all the labor related charges, installation charges, all the things which are being incurred to bring that property into the existence, into working condition, is called as a purchase price for the asset, and that purchase price is your cost basis. Okay guys, next is if you get the property in the form of gift. Okay, someone gifted you the property, the price of that gifted property will depend on two things. The basis of that property will depend on two things. One is appreciated property and second is depreciated property. Okay, so what do you mean by appreciated property? If the FMV of the property on the date of gift, okay, in market the value of that gift is higher as compared to the donor's basis, whoever is going to donate the property, who is going to give the property, his basis you are going to compare with whatever is the FMV. Okay, if the FMV is higher, that is called as appreciated property. Simply you have to take whatever is the adjusted basis of this donor, right, and add the gift tax proportionate amount. Why I am saying proportionate amount? Because whatever gift tax you have paid, you have the option that in case of gift 16,000 of deduction can be taken, right? So gift tax paid multiplied by FMV minus donor's basis. Okay, whatever is the donor's basis minus FMV means this much is the extra benefit which you are going to get. Divide by amount of gift means nothing but your FMV minus 16,000. Here please change the formula, right? The 15,000 is written over here, but it has to be, the formula should be gift, amount of gift minus 16,000, and on the upper limit, like on the upper hand, it should be FMV minus donor's basis. So this much amount you need to add to the adjusted basis of the person who is donating the property. Okay, that much amount will be your cost basis, because in future, even though you have received it as a gift, in future at any time you might be selling the property, so you should know the cost basis to identify the capital gain or loss. What do you mean by depreciated property? Depreciated property means a reverse case, means let's say the FMV is less than the donor's basis. Okay, that is known as depreciated property. So here the trickiest part will come, but no need to worry, like you have to just follow this rule. Just a minute. In next few pages there is this property disposition topic. Yeah, so see, whenever you are going to sell the property and when you received that property as a gift, okay, so in that case what will happen, the gift which you have received is a depreciated property, right? Depreciated means what? The FMV is less than the donor's basis, right? So you have to just simply draw this timeline. Whatever is the FMV, take it, mention it over here in the timeline. Okay, donor's basis you take it. In our example, the book value is 10,000, means the adjusted basis of the donor is 10,000, FMV is 6,000. Okay, so can I say this is my depreciated property, right? So just draw it on the timeline. Okay, now you have to identify whenever you are going to sell the property, at what cost you are going to sell it. Are you going to sell it before, like less than the FMV? Are you going to sell it for more than the cost basis, or are you going to sell somewhere in the middle of FMV and the donor's basis? Means whenever you are going to sell this gifted property, which you at the time of taking the gift, it was a depreciated property, what you are going to do is check that at the time of sales, what is the amount or what is the sales price at that time. Okay, let's say the sales price is 3,000. So can I say it is less than the FMV? So simply take the cost basis as FMV. Simply take the cost basis as FMV. Okay, but let's say if the price, the sales price of this gifted property is more than the donors basis, it's 12,000. Can I say it's more than the FMV? Even it's more than the donors basis. So what you're going to do is, if it falls more than the donors basis, take as it is the donors basis, adjusted basis, as the adjusted basis at the time when you're going to calculate the gain. Okay, but let's say if you're selling the property somewhere between 6,000 and 10,000, somewhere between the FMV and the donors basis, it will be called as no gain no loss situation. There will not be any gain, means your selling price is equals to your cost, means selling price minus cost. When you do, you will receive no gain no loss. Okay, zero gain and zero loss. Got it, guys? This was an important which I wanted to explain. In class we have done it very well, right? Taking some examples. Same way you have to, in exam you have to just follow this timeline. This timeline is most important, because in exam they will not give you in a simple language. They will give you in a very whole paragraph format. So just draw this timeline, that if it's a gifted property and if it's a depreciated, okay, if it's an appreciated property, what will happen? Simply you have to take whatever is the donors basis, add the gift tax proportion if any. Okay, gift tax proportion calculation, how it will be done? It is mentioned on the first page, right? See, just a minute. Yeah, here. See, here those who have joined late, I'm just mentioning that thing again. Gift tax into FMV minus donors basis. Okay, divide by amount of gift. Amount of gift is nothing but your FMV. So can I say this formula can be simplified as gift tax paid multiply by FMV minus donors basis divide by FMV, this is the value of my gift, minus 16,000, because 16,000 is a gift tax exclusion we have done in the gift tax topic. Okay, we'll do it in specialized written again. So 16,000, so here actually there is a typing error, so you have to just take this amount and put it over here in the divide. So just follow this formula. Okay, gift tax paid multiply by FMV minus the donors basis divide by FMV minus 16,000. This much amount proportionate you have to add to the donors adjusted basis. This is the recipient's basis. Okay, got it, guys? So this is in case of appreciated property. In case of depreciated property, basis will be only known once you sell the property, once you dispose of the property. So if the selling price, right, will be less than the FMV, directly take the FMV as the basis. Okay, we have drawn the timeline, we have understood it through the timeline. This is my FMV, this is my basis, donors basis. Okay, if I sell it somewhere over here, means can I say if I sell at less than FMV, my basis will be FMV. Got it, guys? If I sell at more than the donors basis, okay, more than the donors basis, then my cost basis will be my donors basis. Okay, means my selling price is more than the donors basis, the basis will be the donors basis. If it is falling between these two amounts, it will be no gain no loss situation. Got it, guys? Okay, next is if you receive certain property in inheritance. What do you mean by inheritance? If a certain person is, if a particular taxpayer is dying and in his will he has mentioned that this much property will get transferred to my beneficiaries, right? So in that case, what will happen? Always remember that any transfer in case of inheritance will be taxable as a long-term capital gain. Understand this. Meaning you have to identify whether it's a long term or a short term. Always inherited property are called as a long term. Now how you are going to calculate it, how you are going to consider the value, because you have received it in as an inheritance. See, if you received it as a gift, there is a totally different calculation. If you receive in the form of inheritance, always it will be called as a long term. Basis will be the FMV either on the date of death. On the date of death, directly take the FMV. Or if the, in case of estate calculation, we'll see over there, they have the option that is alternate valuation date. Right, you might have already done the regular class, so you should know what is alternate valuation date is. From the date of death, you will simply add 6 months to it. So whatever is the FMV on the alternate valuation date, that you will take if they have elected to take the alternate valuation date. If not, then directly take the FMV on the date of death. Okay, now what will happen? Sometimes before alternate valuation date, if transfer is taking place, then take the FMV on the date of transfer. Okay, this is what it is mentioning. If the asset is distributed before alternate date, that is 6 months before the date of alternate valuation date, the basis will be FMV on the date of distribution. Got it, guys? This is about the basis of property. We have already done very well in the class about what is the purchase. If we directly purchase it, just take the cost plus all the expenses which are incurred to bring that property into existence, right? All the labor related costs, all the installation charges, even the sales tax will be added in the purchase price, okay, at that time. Then gift is there. We have to check whether it's appreciated or depreciated. Based on that, you need to identify what is the cost basis. The cost basis is very important to identify for capital gain topic. What do you mean by capital gain? Sales price minus cost, right? So that's why you need to identify very well what is the basis of the property. And third is inheritance. It will be always taxable as a long term. Okay, this is just the calculation which is mentioning original basis plus capital expenditure if you have incurred minus depreciation is called your adjusted basis. Okay, holding period is nothing but the date on which the donor's adjusted basis is used, then include the holding period of the donor also. In case of gift related properties, let's say here at the time of depreciated property, sometime we are going to use the donor's basis, sometime we are going to use the FMB. Right, so if you're using the donor's basis, then the holding period will start from the date from which the donor actually held the property. Holding period, if do not use donor's basis, means in our first situation where we use the cost basis as FMB, then holding period will be start from the date of gift. Okay, for purchase it's normal, holding period will start from the date you bought the asset. In gift it's normal, the holding period will start from depending on which basis you are using. So that is why basis importance is there in 2-3 different criterias. Okay, to understand that, you need to first figure out what is the basis of the property. Now, how the capital gain and loss will be reported? It will be reported on the Schedule D. If it's a real property or a personal property, you already know the meaning. Real property means anything which is attached to the land. Personal property which is not fixed to the land means, can I say this is a movable property and this is immovable property in a very simple language. Okay, so real and personal property both can either be a capital asset or both can either not be a capital asset. Okay, what do you mean by capital asset? If all other assets which are held by the taxpayer, which is not used in trade or business, okay, which is not used in trade or business or not used in any inventory, means when you look at the balance sheet, right, balance sheet, we have your fixed asset. Also, we have some other assets such as stock, shares and securities, right, that are also our assets if we have bought it. So these are not your capital asset, right? So all the asset, inventory is also mentioned, that are not your capital asset, but fixed asset which are not used in trade or business, means you're not using it as an inventory, you're not trading those assets, right, that are called as capital asset. Not a capital asset means inventory which are included in your balance sheet, treasury stock, the shares and securities, those are not your capital asset. Okay, just read the definition once again. If you have the book right now, just go through it and mention the definition over here only. What is capital asset and what is not capital asset? Okay, I think there are some examples which will be there in the Gleam book. Then we have holding period will exclude the date of purchase, but it will include the date of sale. Okay, to calculate the holding period, why holding period is important? Because if you held the asset for less than 1 year, it will be called as short-term capital asset. If it is more than 1 year, it will be called as long-term capital asset. If it is a long-term capital rates will apply. If it's a short-term, what rate will apply, guys? Anyone can tell me? If it's a long-term, it will be long-term capital gain rates will apply. If it's a short-term, anyone in the chat box can mention, if it's a short-term capital asset, what rates will apply? Anyone? Yes, ordinary tax rate will apply because being a short term. Okay, this we have already done. So please make sure to identify the holding period. They will twist the question based only on one date. You have to make sure to exclude the purchase date. Let's say I have purchased the property on 1/1/2022 and I'm selling the property on 31st Jan 23 on 1st Jan. Okay, let's say 1st Jan 2023. So this date I'm going to exclude. From 2nd of Jan, I'll have to check that whether it is 1 year or not. So it is not 1 year because the 1 year will be on 2nd of Jan 2023. They will twist the question based on this also. Okay, so please remember to identify what is the holding period, and based on that, if it's less than 1 year, it will be short term, and if it's a short term, it will be taxable at the ordinary tax rates. If it's a long term, it will be taxable at the long term capital gain tax rate. Now, how you are going to calculate it? It's simple formula which we in any layman language I can explain. Simply the selling price minus the cost of the property. What do you mean by selling price? Here the selling price will exclude the selling cost. Let's say you have incurred certain selling costs, right? Let's say you've incurred certain paid certain commission to the title company, or any XYZ expenses which is incurred by the taxpayer, by the person who is selling the property, will get excluded. So selling price minus selling cost, this is my amount which is realized. Out of this, I am going to reduce the adjusted basis of the property. Okay, what is the adjusted basis? Simply whatever property you have purchased, take all the cost price, reduce any depreciation if you have charged, any addition if you have made. So that is my adjusted basis of the property. I can also say it as a net book value of the property immediately before the sales of the property. I'll reduce that much. This is my gain or loss. Now this gain or loss can either be taxable or can be exempt, or if this is a loss, either it can be included or it can be disallowed. So we'll have to understand how much gain we are going to exclude and how much loss we are going to disallow if it's a wash sales, if it's a sales between the related party, or it's a personal sale. So in these three situations, we are going to disallow the losses. Okay, so let's first understand how much gain we are going to exclude. First is homeowners exclusion. We have done this topic previous day only. If you are owning a home, if you remember the ownership test and the use test, if that is fulfilled, 2,50,000 and 5 lakh you were able to exclude. Right, homeowners exclusion is allowed if you sell the property. So from gain you can straight away exclude 250 or 500, right? Second is involuntary conversion. Now what do you mean by involuntary conversion? First let's complete that one and we'll come back to that topic. Yeah, here it is. So see what happens. The involuntary conversion means what? If your property is lost due to theft and you receive a claim, or let's say your property is acquired by the government. Okay, involuntary means you were not voluntarily willing to sell your property, but still due to some circumstances your property got lost, your property got acquired by the third party, by the government. Okay, then it is called as involuntary conversion. This means that this is a sales of property. But here the sales property, like in case of sales, what we take directly, we take the sales price, whatever benefit we have received minus cost. But if we do the same things over here, that is not feasible for a taxpayer to pay whole amount of tax on that. So what we are going to do, we are going to compare our cost, right, with our FMV. Okay, whatever is the cost and FMV difference, that is a deferred gain. I was not willing to sell my property, so that's why I'm not liable to show this much tax. I'm not liable to pay the tax on this much amount, right? So whatever is my cost and FMV will be my deferred gain, and then whatever is the difference between my FMV and against the FMV, how much I'm going to receive from the insurance company, how much I'm going to receive from the government. Okay, so that difference is my actual gain. Okay, recognize, and this is my total realized gain. Okay, let's see this example quickly. The property which I'm holding is having a net book value of 4 lakh. Okay, so I'm having a property of 4 lakh. I'm not willing to sell it or give it to some third party. The FMV of my property currently is $4,40,000. Now state took the property and gave me 4,50,000. State means the government took the property and gave me 4,50,000. So can I say there is a whole profit for me of 50,000? The value of my property is 4 lakh, but state gave me 4,50,000. So whole 50,000, should I recognize it? No, because it was not my will to sell the property to the government, right? So only and only the difference between the FMV and whatever I am receiving from the government, I will consider it as a I can say recognized gain. See, this total 50,000 is my realized, this much gain I am realizing, but I have to recognize only the difference between the FMV and whatever I am receiving. Okay, next is, what about the deferred gain? Now this much amount which you are deferring it, what you will do it in future, like let's say this 4,50,000 you took and you purchase another property. Okay, now this another property which you are purchasing, in that case only the involuntary conversion rule will apply. It will not apply that you took the 4,50,000 and put it into some investment, into some FD or anything. At that place, involuntary conversion will not apply. Involuntary conversion means your one property is acquired, against that you receive either another property or you receive a cash. Using that cash you are buying another property. Okay, so whatever is this deferred gain, na 40,000, it will be added to the new assets cost. Okay, whatever is the new asset which you are going to buy, take that amount, add the deferred value to it. Okay, so now what will happen? See, let's say that new asset I'm selling at 6 lakh. I'm selling that new asset at 6 lakh. So what will be the treatment? Let's understand it. Gain on sales of property. What was my value of the property? My original value was what? 4 lakh, right? 4 lakh was my initial cost. So that will be my cost basis. 6 lakh is the amount which I received from selling the property, right? So 2 lakh is my total gain. Okay, but let's see how much you are going to recognize, how much you are going to defer, how much you are going to realize the gain. Okay, and how much will be the value if you buy a new house using this 4,50,000. So what will happen is, take directly the FMV of the asset which is acquired, sorry, which is for which you are buying a new house. So directly take the FMV of whatever asset is acquired, 4,40,000 minus deferred gain. So this will be the basis of new property. Means, can I say you are not going to pay the tax on the 40,000 as a, being a deferred gain, but you will have the option to reduce this deferred gain from the value of new house which you are buying. So see, using this 4,50,000, you are buying a new house, right? So simply take the FMV and reduce the deferred gain. Okay, FMV minus deferred gain. This is the value of new property. Okay, now the steps, these 3 steps, you have to just follow these 3 steps. First is calculate the realized gain. So what is my realized gain? 4,50,000 minus 4 lakh, it's 50,000. Out of that, how much I am going to recognize? Only the difference between the FMV and the actual price which I am receiving from the government. So only 10,000 I can recognize out of 50. So remaining 40 is my deferred gain. It will be added to the cost of new asset. Okay, sorry, it will be reduced from the FMV, not added. Sorry for the this thing. 4,40,000 was my FMV. Out of that, the 40,000 which is deferred gain will get reduced. It will not again added, it will get reduced. Okay, indirectly I have explained this why we are going to reduce it, because indirectly the taxpayer is going to receive this benefit, right? Right now they are not including this in the income, they are not going to pay the taxes. So on the other hand, whatever is the value of new asset, you are going to reduce the cost of that much asset. See, let's say if 4 lakh is my value, okay, 4,40,000 was the FMV. Now I straight away take this as a cost basis, and when in future I am going to sell it at 6 lakh, what I am going to reduce? Straight away 4,40,000 I am going to reduce, right? And in that case you receive a gain which is on a higher side, right? So 2,60,000 is the 1,60,000 is the gain which you are going to receive. Got it, guys? In this situation, if I am going to reduce the 40,000 from here, what will be the gain which I'll get is minus 4 lakhs. So here ultimately in future the 40,000 deferred gain is included in your capital gain. Right now, if you do not exclude, I have explained this in the class why the reason is deferred gain will be excluded from the FMB, from the basis of the new property, because in future when you are going to sell it, anyways you are going to realize this deferred gain. Why we are deferring this gain? Because we were not ready to sell the property, but now when you are actually selling the property, this deferred gain needs to be taxable in your tax return. But they will not add back the deferred gain, but from the initial stage only they will reduce the basis by this 40,000 of deferred gain. Okay, got it, guys? Please go through the MCQs on this topic. They are very good. In involuntary conversion topic there are a lot of MCQs, and in exam they will ask some questions on this topic. Okay, next is Let's come to, we were reading about what gains needs to be excluded. First was the homeowners exclusion, second is involuntary conversion, third one is divorce property settlement. If we have done the community property, right? So if you have a community property together and later on at the time of divorce that property is getting segregated between the taxpayer and the wife, okay, this is kind of a transfer between the taxpayer and the wife. So this thing is not taxable as per the IRS law. This capital gain will not be included as a taxable for any of them. Okay, exchange of like kind business, this is will be a part of your part 2 topic. So right now I'm not going to explain this thing again and again. Okay, this is again going to be covered in your part 2 topic. Okay, so whenever we do the part 2 revision, please make sure to at least revise that much topic, but I'll explain just a glimpse of it. Like what we have done is, when one property, do you remember the chart we used to draw like this? When one property is transferred to Mr. A is transferring a property to Mr. B, and then Mr. B is transferring some property to Mr. A. So this is a like kind exchange. Same property has been transferred for same other property. Right? If these things happen, what you are going to do, all these exchange will be non-taxable. Only the taxable thing was a cash bought amount. If you remember, we have done the 3 steps for that calculation, right? So okay, no worries, I'll just take that topic because I think it will be a lot of confusion if you don't do the topic right now. Let me check part 2. It's part 3. Just a minute, guys. Wait a minute. In our 18th September, 17th July batch, it will be there. Okay, I hope here it is. Yes. So let's do that like and exchange right now only. And for part 2, I'm not going to take it again. I'll just cut the same video and put it over there. Just a minute. Here it is. Yeah. We'll just directly take one example. Okay, we are not going to do all the theory again and again. I'll just directly take one example for a better understanding. Just give me a 1 minute. Okay, so see, here is one example. Adam and Charlie, they both are transferring the property. They both are transferring an apartment house against an apartment house. For example, let's take the same kind of property. Okay, and the FMV of the property which Mr. A is transferring to Mr. C, the FMV is 2,20,000, and the property which Mr. A is going to receive, the FMV of that property is 2,50,000. They will give you FMV, they will give you adjusted basis, they will give you the mortgage attached to it. So the adjusted basis of this property is 1 lakh, the adjusted basis of the Charlie's property is 1,75,000. Okay, and the mortgage attached to it is 80,000, and mortgage attached to Charlie is 1,50,000. So what will happen is, you have to check that what other benefits the Adam is going to receive. Adam is also going to receive a cash of 40,000. So this is straight away your bought amount. Okay, so instead of receiving a property, if you receive any other property, any other than the similar property, if you receive any other property, or let's say you receive cash, that is your bought amount. Okay, but there is a steps which you need to strictly follow, else you won't understand it. So please understand this properly. First step is, this is our first step. Step 1 is calculate the realized gain. Realized means whatever benefit Adam is going to receive, they are going to add it. Whatever things they have given up, they are going to reduce it. Okay, the person, Mr. A is going to add all the benefits, reduce all the things which they have given up. FMV of the property received, whatever property Adam is going to receive from Charlie, they are going to add this 2,50,000 as a FMV. Plus, what other things he is receiving is cash. So 2,50,000 plus cash 40, plus buyers assume his mortgage interest. So can I say the mortgage which is attached to the Adam's property will now be assumed by Charlie. So can I say it's a benefit for Adam that now he will no more be paying any mortgage payments. So this 80,000 will now be added over here as a benefit. So take 2,50,000 FMV of the property received plus cash received plus his own mortgage which is assumed by the other person. So this is my total realized amount. Now out of this I am going to reduce the cost thing. So what is the cost basis of my property? Since I am going to Adam is going to give his own property to Charlie. So Adam's property has a cost basis of 1 lakh. So you are going to reduce this 1 lakh. Right. Second thing, instead of giving up this mortgage, he is going to assume the mortgage of Charlie's property, which is 1,50,000. Okay. Third thing, he also paid a exchange expense of 10,000. So whatever things he paid, whatever things he is going to give up, he need to reduce it as a cost. So adjusted basis of the property, mortgage assumed, he is going to reduce. So this is my realized gain. Okay, now out of this, see this 10,000 right now don't exclude it. This will calculate in the bought calculation. When we do the bought calculation, that time we'll see. Okay, so first step is clear. What is your realized gain? Okay, take the FMV of the property received, take the mortgage which is assumed by the other party. Okay, and take any cash which you are receiving. So these three things are anyways going to be there in the exam, in the question. And now you have to apply your mind while reducing. Do not make a mistake to reduce the FMV, guys. Always remember, they'll confuse you. They will give you all the amounts. You have to compulsorily draw in your rough paper this chart. Draw party 1, draw party 2 like this, and then mention all the amounts in this form. Okay, this we have done in class very well. Use this format only. Do not apply your mind. Do not change the format at all. Okay, then you are going to receive a realized gain. Then we have second step is, step 2 is nothing but your bought amount. What do you mean by bought amount? Bought amount is nothing but whatever benefits you have received. Cash received. See, Adam has received a cash of 40,000. Okay, minus exchange expense plus net liability. What do you mean by net liability? What liability I have assumed? Adam has assumed 80,000. Okay, and Adam has assumed 1,50,000. Charlie has assumed 80. So can I say he has assumed a higher liability? So it's not a benefit for him. But for Charlie, it's a benefit. So that's why it will add it in his bought amount. Got it, guys? This thing you have to apply in the same formula. Cash received minus exchange expense plus net liability. So total is 40,000. So this 40,000, actually here the exchange expense are not reduced. Yeah. So exchange expense here are paid by Charlie. That's why it is not reduced in the Adam's cost. Okay. So what Charlie is doing, Charlie is paying cash also, Charlie is paying exchange expense also. Okay, so when we are going to calculate for Charlie's point of view, we are going to reduce the cash paid also. We are going to reduce the exchange expense which Charlie is paying. But for Charlie, the benefit is instead of paying the 1,50,000 of mortgage, now the Charlie has to pay only 80,000 of the mortgage. So whatever is the remaining amount is a benefit for Charlie. So that amount you are going to reduce the cash paid, you are going to reduce the exchange expense. This much is the bought for Charlie and this much is the bought for Adam. Now step 1 and 2, whichever is lower, you are going to recognize that much as the gain from like kind exchange. Got it, guys? Got it. Second is same thing, same formula you are going to apply for Charlie. Okay, take the FMV of the property received, which is 2,20,000. Reduce the adjusted basis, that is 1,75,000. You are going to add 1,50,000 because it's a benefit for Charlie, right? You are going to reduce 80 because you have assumed the 80,000 as a mortgage. So 2,20,000. Also, you are going to consider here exchange expense because it is paid by the Charlie. It was not paid by Adam. It's paid by Charlie. So also reduce the exchange expense. 2,20,000 is the FMV of property you are receiving. Reduce any cash paid. Okay, that is your exchange expense plus mortgage which is being assumed by the Adam for the Charlie. This is our total amount realized. Out of that, you are going to reduce the adjusted basis of property transfer, reduce the mortgage which you have assumed, cash paid. Okay, to Adam they have paid the cash of 40,000, so you are going to reduce. So whatever is the ultimate realized gain, that you need to compare with the bought amount. In bought amount, I have already explained you guys. Net liability. See, I am repeating this thing again and again because you should not, mug up the formula, but understand the concept actually. Just think in a layman's language. For example, I am transferring a certain property to Hina. Okay, so Hina is going to consider it in her tax return, how much she is going to make it taxable. If she is transferring some other property to me, how much I'm going to make taxable that transaction, that will depend on this all things. Okay, how much is the value, FMV, adjusted basis, what cash is paid, how much exchange expense is paid. Okay, all these four things, and the mortgage assumed by each party. So these 5 things, if you have on hand in paper, jot it down and apply these steps. Step 1, step 2. Okay, now most important step is step 3. How much you are going to recognize? This is the step 3. In exam they will ask you the question for the step 3 only. So this step 1 or step 2, whichever is lower, right? So in this case, whichever is lower comes to 40,000. In this case, whichever is lower comes to 20,000. So Charlie will recognize a gain of 20,000 and Adam will recognize a gain of 40,000. Got it, guys? Now the most important is, what is the basis of property? See, the Charlie is transferring the property now. For Adam, in his books, at what amount he should record the books, the price of the property. Okay, in his books, how much will be the price, how much will be the basis of the properties, because in future it might happen the same property is getting sold to some other party. So at that time he need to calculate the gain or loss. So, but what cost basis he should take? So it depends on one more formula, that is basis of the property transferred. Whatever property he is transferring, what is the basis of that property? It's 1 lakh, right? That is 1 lakh. Now what you are going to do, whatever payments you have made now, add it. Whatever benefits you are receiving now, reduce it. So did the Adam made any payment, bought payment? No. Okay, did he made any exchange expense? No. Did he recognize the gain? Yes, he recognized the gain and paid a tax on 40,000. So step 3, you are going to add it over here straight away. Minus bought received. Did he receive any benefit? Let's see the step 2. Yes, 40,000. So step 3 will be added, step 2 will be reduced. Okay, and before that you have to check that whether he has paid anything. If he has paid anything, he is going to add it to the value cost basis of the new asset which is receiving. So after adding and reducing, we receive the amount that is the basis of new asset. Same way for Charlie, we will be seeing here the calculation is done for Charlie. Let's see, the Charlie's basis is what? The cost basis of the Charlie's asset is 1,75,000. Is Charlie paying any expenses? Yes, 10,000 we are going to add it. So 175 plus 10. Is Charlie paying any cash directly to Charlie? Yes, 40,000 we are going to add. Okay, then what I mentioned is step 3 will be added and step 2 will be reduced. So you'll have to add 20,000 and you'll have to reduce 20,000. Got it? The bought amount you are going to reduce. Okay, and recognize gain you'll have to add. So same thing is done. 175 plus 40 plus 10 plus 20 is our step 3. Sorry, and step 2 is nothing but our bought paid that you are going to reduce. Got it, guys? This is simple formula, and the same topic is there in the part 2 and in part 1 also. But in part 1 exam, it's very rare possibility they will ask you this calculation sum. Okay, but we should not leave any topic like that. Okay, so this was about the like kind exchange. In that case, we have already done so much examples in the class. Just a minute, guys. Okay, so this was about the exchange of like kind property. If it's a 1031 exchange, you have to disregard certain amount, right? Step 2 or 3, whichever is lower, sorry, step 1 and 2, whichever is lower, we are going to recognize only that much, not more than that. If you don't receive any bought, if you don't receive any benefit, there is no taxability for that transaction. Okay, substitute old basis with the new basis means, as we have seen that old basis will be the basis of my new property, plus anything benefit which you have received will be reduced. Anything which we have paid will be added to the basis of that new property. Okay, installment sale, we have already seen this. In case of the installment sale, you have to do the proportionate. You have to check out the gross profit percentage. What do you mean by gross profit percentage? Whatever is the sales price minus cost, that is your gross profit. That much is your capital gain. Only that much should be recognized in your I can say tax return as a capital gain. But what happens now, sometimes the person who is selling the property asks the taxpayer to pay it in installment basis. So all installment is not your capital gain. You have to categorize it into three parts. If you remember, first we remove the interest, second we check that how much is the gross profit percentage which will be applied to that particular amount, and remaining is my cost. It's just a recovery of the cost. That treatment you don't have to give at all at any point of time. You have to just take this gross profit amount and make it taxable in your tax return. Okay, so this cost basis will not be considered as a capital gain at that point in case of installment sale. Treasury stock, in case of sales of treasury stock, the gain will not be recognized in schedule D over here. We'll see that there are certain other treatments for that. Okay, next is losses. If you have a loss and if it's a wash sales, what do you mean by wash sales? We have already seen that on the date of sales, right, after the date of sale, within 30 days you bought the same property, same transaction, same stock and securities I am talking about, not property. Same security if you bought within 30 days from the date of sale. At the time of sale you incurred a loss, and after 30 days you bought back again the same property. Same way at the time of sales, right, just before 30 days you have bought the property and now you are going to sell the property for loss. So this loss will be disallowed. Okay, you purchase the security either 30 days prior to the sales date or 30 days after the sales date. The proportionate amount will get disallowed. Now what happens for this disallowed loss? This wash sales disallowed amount will get added to the basis of new shares which you purchase. Let's say here the loss is disallowed, so it will be added to the basis of this asset. Same way, if the loss is disallowed, it will be added to the basis of this asset, and when you are going to sell it, ultimately you will not be allowed to take that loss as a deduction on your tax return. Okay, the concept is this: to save this planning, they have came up with the rule that is wash sales within 30 days from the date of sale or prior to 30 days from the date of sale. If you bought the same type of securities, whatever loss you incurred on the sales date will be disallowed, but what it will happen is it will be added to the basis of the new stock. So when the new stock you buy now, you are going to add, let's say you bought it for 100 and already you have a loss of $50. So basis of this new share will be $150. So let's say in future when you're selling it for $300, you're going to reduce whole $150 and only $150 will be taxable. Okay, but let's say if you don't add this $50, what happens? $300, I sell it for $300 and now I will be just reducing $100, $200 will be taxable. So ultimately this loss will be allowed to you in future. I can say it's a deferred amount which will be allowed in future when you sell that new property, new asset, sorry, new security, shares and security. It's only and only for the shares and security, guys. Don't get confused. Okay, next is, in case of sales between related party, most important, 1 or 2 questions will be there based on this topic. Whenever there is a related party, I took example of my sister, right? My sister is a related party to me. So when I'm going to sell her certain property, let's say I'm selling a property to my sister for 7,600. The cost basis, I bought that property many years ago for $10,000, right? So cost basis for me is $10,000. I'm not going to charge any depreciation. It's my personal property, right? So $10,000 was my cost. I am selling her it at $7,600. So can I say I have incurred a loss of $2,400? But since she is my related party, I cannot claim this $2,400 loss as a loss on my tax return. But she has the option when she sells that property further in the market, right? Whatever is the gain, she can reduce her gain amount by this disallowed losses, which was previously disallowed. Okay, so if the related party further sells it at 10,500, okay, if she's selling it at 10,500, what will be the gain she is going to incur is 10,500 is the selling price minus, for her the cost will be 7,600 because she has paid 7,600, that is her cost, that's it. So 2,900 is the gain. Is it fair to recognize whole 2900? No. Whatever was previously disallowed should get reduced from this 2900. So 2900 minus 2400, whatever is the remaining 500 should recognize gain only for $500, not more than that. Okay. Next is personal losses will be disallowed. If you have any personal losses, that will not be allowed on your tax return. Got it, guys? Anything is left? I don't think. From the basis we have done the reporting, we have done the disposition of or sales of property, right? Reporting the gain, and then we have done the securities. Okay, let's understand the securities. Whenever you have a stock or bond, the basis of that stock or bond will nothing but your purchase price plus cost. There won't be any depreciation in this, right? If there is any addition in the same type of security, you're just going to add it as a cost basis, and then you receive an adjusted cost basis. Now remember one thing, if you receive a stock dividend, stock split, we have already understood that if you receive a dividend in the form of stock, or if you receive a stock split, for one stock you are going to receive 2 more stock, you are not going to change the adjusted basis. See, 10 stock are there at $10, so you have already 100 as your basis. Now you are receiving 5 more stock as a stock split. For each stock you receive, for each 2 stock you are receiving 1 stock. So now what is your total number of shares which you are holding is 15. You are not going to multiply it by 10 and make it as a $150. No. This we have already seen that per share price will change. This will remain the same as $100, right? And this per share price will get changed. You are not going to change the main basis of that particular stock, that securities. Okay, in case of stock dividend, also in case of stock split also, both will be the same case. Okay, next is return of capital. When you receive a non-dividend distribution, you are just going to reduce the basis. If you receive a distribution which it will be mentioned in the 1099 DIV form only that this is my this is my non-dividend distribution, right? So what will happen is, whatever amount you receive as a non-dividend distribution, it will not be taxable, but it will reduce your basis. This $100 was my basis. This basis will get reduced. Now let's say your basis reduces and becomes 0. Still again you are going to receive a distribution. So extra distribution which you receive, which is over and above your basis, is your capital gain. Got it, guys? This we have already seen. If it's a stock dividend or stock split, we have to just adjust the share price per stock, right? If it is a dividend distribution, then it is normally your ordinary income. If it's a non-dividend distribution, not from your retained earning, they are just giving you as a return of your capital, then it will reduce your basis. But once your basis is reduced in negative form, once it go to less than 0, whatever is the extra amount which you receive, still you are going to receive any more amount. If your basis is 0, right, then it will be your capital gain. Okay, subsequent transactions, for every transactions you are going to calculate a FIFO method. There is no LIFO or any other average method is not used. For securities transactions, only FIFO method is used. Okay, mutual fund, all the subsequent transactions will be considered on FIFO method. Mutual funds concept we have already done very well in the class. If you have a mutual fund, it's nothing but all the assets are being invested into different I can say pool. A whole pool is there, and all the different amounts are invested into different shares, securities, stock, and everything, right? So whatever you are going to sell, the units will be calculated as a FIFO basis. Like what is the first unit, what is the price of that first unit, cost basis will get reduced. There are no technical questions from this topic, guys. So just understand the importance of stock dividend, stock split is important, return of capital is important. If you receive a non-dividend which is more than your capital, it will be capital gain. That's it. That much is important, not more than that. Second is options. In case of options, we have done it in class, but it's a little bit confusing. Those who are not from the commerce background, or those who have not done derivatives topic at all, they might find this thing a bit difficult. Option is nothing but it's just an option that you are promising currently that in future you are going to buy a certain shares, or in future you are going to sell certain shares. Actually, you're not going to buy or sell. You are just, placing a bet. I can say that in future, if whatever is the price, if today I have bought the shares for $10, actually I'm not buying the shares for $10, but at future date, let's say after 6 days, I am going to buy a shares of X and company at $10. Now in future, what happens is, in after 6 days, what happens is the price of this $10, this X and company shares, goes to $9. So can I say it's a benefit of $1 for me? Or if this price goes to $15, so there is a loss for me for $5. Okay, so this is nothing but when you promise to buy, that is a call option. When you promise to sell, that is you're putting up, like it's a put option. This we have done very well in the class. I'm not going to again waste time on explaining in very detailed manner. Just remember this thing. If you are a put buyer, what will happen? Take the cost of put, whatever you are paid to buy that put, minus amount realized on sales of stock. Put means you are going to sell the stock in future, right? Let's say you are selling at $15. So realized amount you are going to minus and take the cost of the put. That will be that will not report it separately, but the option cost will modify the basis. So whenever the stock is being sold, you have to reduce the cost basis, right? So this is what we are understanding is what will be the cost basis of that shares which you are buying and selling. Okay, put buyer. Call buyer is nothing but whenever you are going to promise that I'm going to buy certain things. So cost of call plus basis of stock purchase, whatever purchase you are doing, let's say at $9 you have purchased the stock, so take $9 plus cost, whatever you paid to buy that call at the first day. Okay, same way put seller. See, if the person is buying the call, someone might be selling the call now. So for that you have to see the reverse case. For put seller, basis of the stock purchase minus amount received by selling the put, and for call seller it will be amount realized on the sales of stock plus amount received for call. Okay, this is simply this is not going to ask an exam at all. This is just for understanding. If you exercise it, what will be the cost basis of the stock, share, security which you are going to exercise. Okay, this is helpful in practical life, not in exam purpose. If it is not exercised, the IRS will consider that the option was sold or traded on expiration date. As soon as it expires, as soon as the option expires, it will be considered as it is sold on the expiration date, and you will be liable to pay capital gain tax on whatever amount is sold. Okay. Then we have 1244, section 1244 and section 1202. 1244 was what? Small business stock. Loss can be offset against the ordinary income. We'll see that how we are going to offset the incomes and losses later on. But remember, if it's a small business stock means what? If it has a capital of up to $10 million, right? Then the loss can be offset against ordinary income, but the maximum limit is 50,000, and in case of MFG it is 1 lakh. Got it, guys? If you have a shares and securities, if you have a stock of a small business, then you can offset your loss from selling that shares and securities against your ordinary income. Even though if it's a long term or a short term, doesn't matter. Up to 50 and up to 1 lakh you can set off. In section 1202, what was the scene? That if it's a C corp, right? This is a small business other than C corp. If it's a C corp up to $50 million, gain can be excluded. The gain can be excluded of 10 million or 10 times of adjusted basis, whichever is higher. Okay, up to that much amount you can exclude, straight away exclude the gain if a C corporation who is having a capital up to $50 million. Okay, no need to remember the limits and everything, but if you can, it's good. But wherever it is important, I'll just let you know. Okay, like credits chapter were there and all other chapters. All right, now next important thing is capital gain tax rate. Many of you like who have not attended this session from me, the regular lectures, for you guys, this capital gain tax rate is a kind of slab rates. So for you, I'll just explain it in a very short manner. Right, if we have, see, these are our marginal rates. Okay, I think it is visible. So these are our marginal rate, means if your income, your taxable income is up to 10,275 or 41,775, you don't have to remember this, but I'm just explaining this for the purpose of capital gain tax rate. 12%, 22%, 24%, 32%, 35%, maximum it will go to 37%. Right, but what is the benefit if you have a long-term capital gain? If you have a long-term capital gain, and if you are falling in a slab rate which is more than 20%, Just a minute, guys, which is more than 20%, then maximum capital gain tax rate which is applicable to you will be 20%, even though you are falling under 22% slab rate or 24% slab rate, 32% slab rate, 35% or 37%, maximum long-term capital gain will be chargeable to you for 20%. Okay, but this percentage will depend on what is your actual capital gain. Okay, guys, so this slab rates which we have done, this slab rates, and this will not be asked in exam. This is just for your understanding purpose. Like in case of capital gain, how much it will be taxable, either it will be 0%, 15% or 20%. The reason why we used to use these three wordings were depending on the slab rates, the original marginal rates. Based on that, you have to check which slab rate are you falling under. If you're falling for more than 22%, the maximum chargeable to you is 20%. And see, this are nothing but, just a minute. Yeah, see, you can see here, these are nothing but your slab rates. I cannot mark over here, but you can see 83,550 for MFJ. All these MFJ rates are mentioned. See, MFJ rate is 83,550, and for single it is 41,775. Just a minute. It's not working. Yeah. So see, for single, if you have seen MFS, it is 41,675. So these are your marginal rates. This is what it is saying. If your taxable income is up to 83,350, up to 41,465, up to 55,800, or all these things, 0% will be chargeable for capital gain tax rate. If it goes more than this, but up to 5,17,000, 15% will taxable. If it goes more than 5,17,000, right, your taxable income goes more than 517, even though you're falling under 22, 24, 32, 35%, 20% maximum will be your capital gain tax rate. Okay, guys, next is I'll try to complete this whole topic, and one more topic I was going to take, but let's see how much time permits. Gain on collectible or qualified small business stock. Qualified small business stocks is nothing but this one. Okay, small business stock means capital whose capital is up to 10 million. For them, flat 28% rate is there. Even if you earn a $1, $2, $3, whatever is, even if you earn $5 lakh as a gain, flat 28% will be there on collectibles and qualified. There will be one question for this percentage. What is the tax rate for the collectible items? That is 28%. Okay, next is unrecaptured section 1250. This I hope everyone has seen the depreciation video which is already uploaded. There I have explained, whenever you're going to sell a property, there is a recapture of whatever depreciation you have charged. Okay, so whatever depreciation you have charged on the particular property, that much, and 1250 is for immovable, means building, land and buildings. On building, whatever depreciation you have charged, it will be recaptured, and flat 25% you have to pay tax. This is your ordinary tax rate for particular that thing. Okay, now how to calculate the gain and losses? Many people find this thing difficult, but it's very easy to understand. If you have a short-term capital gain, this means what? Your holding period is up to 1 year, that is your short-term capital gain. It will be taxed at ordinary income tax rate. Okay, as I have already mentioned that, remember, short-term is always ordinary, long-term is always your long-term, for which this 3% slab rates will be applicable. Now you know how you're going to use this 0, 15 and 20, right? And this ordinary tax rate will apply, means all your slab rates, 22%, 24%, 32%, 35%, 37%, all slab rates which are for marginal tax rates will apply for short-term rates. Now this is the reason why when you have a short-term capital loss, this loss can be offset against ordinary gain. Why? Because it is anyways taxed at the ordinary tax rate, so that's why loss will be offset. Only short-term I'm not talking about long-term cannot be offset against ordinary at all. Only the short-term capital loss can be offset against ordinary gain, but there is a limit that only up to 3,000 you can offset, and remaining needs to be carried forward. Okay, long-term capital gain, whatever you are going to have, that is chargeable to tax rate 0, 15, 20. But if you have a long-term capital loss, right, you have to check, do you have a short-term capital gain? So this gain can be offset, the gain and loss can be offset internally. But if you do not have short-term capital gain, you need to carry forward this long-term capital gain in future years. Okay, so now let's see Now let's see what happens. Combine all short-term capital gain minus reduce any carryover set off from the previous year. But there is a sequence how you are going to set off. We'll see over here. Okay, first let's understand. If you have a short-term capital gain, it will chargeable as a ordinary. LTCG special rate 0, 15, 20. Right? If you have short-term capital gain and long-term capital loss, the higher will be called as a nature. So what? Let's take one numerical example quickly. I know I'm extending this. Since this is just a revision, still I'm explaining a little bit in detail, so there's no confusion for you guys. If it's a short-term capital gain, means you have $1 lakh, for example, as a capital gain, and if you have a loss of, let's say, 1,50,000. So this 1,50,000 will first be offset against this. So can I say now remaining 50,000 you have, when you carry forward, what will be the nature of this carried forward? Whatever is the higher number, you don't have to check what is the positive, what is the negative. Positive is the highest number. No. What is the highest number? 1 lakh is the highest or 1,50,000? 1,50,000 is the highest. So what is the nature of this 150 was long term. So when you carry it forward, the nature will be long term capital loss. Okay. So remember this thing in mind. And next we are going to check about the capital loss carryover. Okay. Same way in case of short term capital loss, if you have and you have a long term capital gain, set it off against each other internally and remaining will get carry forward. Whatever is the highest, it will be the nature of that amount. Okay, you have both short term capital loss also and long term capital loss also. Each will maintain its character, but only the difference is short term can get offset against the ordinary up to 3,000, remaining will get carry forward. Long term capital loss will get carry forward as it is. If I'm going very fast, guys, then please repeat, like please go through the recorded session again. Okay, till evening I'll upload it. Please complete this topic today only. Okay, next is capital loss carry over. How you are going to carry over if the capital loss are higher than the capital gain? What will happen is 3,000, as I mentioned, up to 3,000 maximum reduction is allowed in the year, and if your MFS 1,500, remaining loss will be carried forward indefinitely. There is no period of time to carry forward. Only there was a period in case of charitable contribution. Do you remember, if you have seen the itemized deduction topic which was done on Sunday, that whatever is the unused charitable contribution, that can be carried forward for 5 years only. For any other losses till now, whatever we have seen, any losses can be carried forward for indefinite period of time. Here also the capital loss can be carried for indefinite period of time. Okay, in case of estate or descendant, once the person dies, that is the last year to take the carry over losses as a deduction. Later on it cannot be transferred to the beneficiary, so the remaining loss shall lapse. Now let's understand the calculation of carryover. Please understand this very carefully. First step is this. Based on this there will be question, and maximum people makes the mistake. And you know, those people who pass at 101 mark, 103, who fail at 101, 103 mark, you have to achieve 105, right? So this 2 marks actually are based on some technical topic only, some formula based topic which is very easy to answer, and you made some silly mistakes. Right, so please clear your concept and do not hurry in appearing in the exam. See, I know you have to clear the EA exams in this year or maybe next year. If you are not ready, do not waste your 17,000 rupees in the exam fees. If you are not ready, postpone the exam. Right, but if you are 100% confident, if you know all the technical things, right, if you are able to achieve at least 80% in your MCQs, where whatever softwares you are using to solve the MCQs, if you are at least achieving 80% to 81% score, then you are perfectly ready to appear in exam. Apart from that, if you are just achieving 60% score, 50% score, based on that, if you think you are ready for exams, then you are wrong. Okay, don't hurry up in giving 2 parts together. Okay, first focus on part 1. I know in December a lot of dates were open and many people might have postponed their exam from October to December. Those who have not postponed, no worries. This revision lectures, go on watching this again and again and again, plus solving at least 100 to 200 MCQ within 3 days. Keep a time slot daily. If you have office, no worries. Whenever you have a break time in the office, at least solve 20 MCQs in break time, right? Okay, so let's move. to our next topic, that is how to calculate the carryover losses, how to settle it off, how to set off. See, first step is whenever you have a capital loss, you are going to set off at least 3,000 in the current year, and remaining, if any, right, remaining if you have any, then it can be used against, then it will be, sorry, it will be carried forward, right? Let's say you have a loss of 4,000. So this 4,000 can be offset against current year ordinary income of 3,000. So remaining 1,000 will be carried forward. Now next year what happens? Now next year, let's say you also have a long-term capital loss. So take the long-term capital loss, whatever is remaining from this 3,000, now reduce that. Let's say you had a loss of only 2,000. So 2,000 you totally offset it against your ordinary income. So what is still remaining in your 3,000 bucket? It is $1,000. So whatever is your long-term capital loss, reduce that $1,000. Okay, and this remaining, if it is nil, then no worries. Whatever is the remaining will get carried forward to the next year. Okay, means here is one exception, as I mentioned, that short-term capital loss can be offset against ordinary income. But in year, if you have a short-term loss also and long-term loss also, this 3,000 limit can be used over here. But if you have only and only long-term capital loss, you cannot use directly 3,000 as a limit. First, that limit has to be used against short-term capital loss, and if there is anything remaining, will be given to the long-term capital loss as a set-off. Okay, and step 3, in the next year, first thing you need to use long-term capital loss against long-term capital gain, and then against short-term capital gain. This we have done very well in the class. If you guys refer to the notes, let's say in year 1, if you have a short-term capital loss and long-term capital loss, so this is wholly offset in the current year only, but this is getting carried forward. In year 2, you have a long-term capital gain, you have a short-term capital gain, and for that year, means current year, means second year, you have a short-term capital loss. So I'm not going to offset this first. First of all, whatever is being carried forward, I'll offset it against LTCG, STCG, and then if I have anything remaining, I will offset this short-term over here. If I don't have anything, I'll carry forward it to the next year. Got it, guys? First preference is given to the long-term capital loss. Always remember. See, there will be one numerical question on the set off. You should not get confused. If you want, you can just mug up the steps. Step 1, use short-term capital loss. Step 2, from this 3,000 limit, if you have anything pending, you can utilize it against the long-term capital loss. Step 3, whenever you are going to carry it forward, how much you are going to set off? Up to the first, you have to set off long-term capital loss against LTCG, against STCG, right? And still there is something gain which is remaining, and then you can use the short-term capital loss against that gain. Got it, guys? Clear this much? Next is disposition in case of gift and inheritance. We have already seen. Please go through this example, this numerical example. For calculating the depreciation, if you have received a gift, right, and in that case, if you are using that property into the business, how much, on what value you are going to calculate the depreciation? Take the net book value, means the donor's basis, or FMV on the date of gift, whichever is lower. That much amount will be used for the depreciation calculation. I think there was one question on this one also. From basis of property, gains and losses, this chapter, there are so many questions. So please do not skip anything from this chapter. Okay, if the property becomes antique or price increases in the future, then you are going to recalculate the depreciation by reconsidering the new price, FMV price. Okay, if the donor paid a gift tax on transfer, the basis will increase. We have already seen on the first page. This is the correct formula. Actually, there was some typo error at that time, so please make sure use this formula, and here please make it 16,000. For 22 tax year, it is 16,000. Okay. Next is qualified joint interest property. If a husband and wife, they both are owning a property. Okay, so it's a joint tenancy with the right to survivorship, or if two partners are holding a particular type of property. So married plus right to survivorship, then half of the value of the property received will be having a step-up basis. Let's say taxpayer and spouse is there. This we have done that if the taxpayer dies, right, the spouse will get the whole property. For spouse, what will be the basis? Whatever is his share, taxpayer's share of FMV of the property into half, that much will be added to the spouse basis. Okay, FMV plus basis, this is the total, and half will be added to it as a new basis of the property for the spouse. Same way for the joint tenancy, the same thing is there. Owner is there and the another owner is there. One owner died. What will happen? Whatever is the FMV into his share, plus you will be adding the cost into first owner share. This is my total basis of the property. We are going to reduce any exchange expense or any title related expense, transfer expense, whichever you are going to pay. The expense of the owner's share will be reduced. Only owner's share expense means only 50%. Let's say they both are owning 50%. So only 50% of the expense will get reduced. This is the new basis of the property. Okay, one example is there. So 30,000 cost is there and FMV is 60,000, right? Depreciation expense are 12,000 and interest in property of A is half, and for B is, sorry, there are total 3, I think. A is half, 2/3 is owned by A and 1/3 is owned by B. Just a minute, guys. 2/3 is owned by A and 1/3 is owned by B. Now A dies, what will happen? A dies, then in that case, new basis for B will be, first you are going to calculate the exact whatever is the ownership, multiply the ownership share of a person who is alive, take the cost for that, take the FMV for the person who is dead. The person who is dead is having 2/3 share. So 2/3 into FMV, 1/3 into the cost. Take this much amount. You are going to reduce whatever exchange expense or any expense on the owner's basis. See, what was the owner's basis? Interest in the property for the person who is still alive is half only, right? The property is owned, the cost has been segregated 2/3 and 1/3, but it's there na, profit sharing ratio might be different, capital contribution ratio is different. Just like that, it is the capital contribution ratio is 2/3 and 1/3. Here they are going to share a profit based on half, 50-50%, right? So the depreciation only 50% will get reduced from this, and remaining will be the new basis for the person who is still alive. Okay, if property is changed from personal to business use, what will happen? Take the FM with the date of change or adjusted basis, whichever is lower. This will be used for the depreciation purpose. Okay, guys, then we have basis used when property is sold. When the property is sold, at that time, if it's a gain, what we are going to do the adjusted basis plus land, adjusted basis of building plus land minus depreciation. Okay, then we have, if we have a loss, take the basis as adjusted basis or FMV, whichever is lower, minus depreciation. Okay, basis which will be used in case of sales of property. Involuntary conversion we have already done. Okay, see here in involuntary conversion, what happens? Here we have seen only in case of profit. What if the government is paying, instead of paying 4,50,000, they are paying you only 3 lakh. So you are at loss of 1 lakh. So immediately recognize whole loss, whole 1 lakh loss. There you are not going to defer the loss. Okay, this is what the last line was mentioned. Okay, so for today we'll end the session over here only, because next we are going to start with the, in taxes topic, those who are having the book now, please go through the first and the KD tax we have already done. Okay, so I'm not going to repeat this again. This was done in the first session only. I'm going to complete the types of taxes, right? Alternate minimum taxes left. QBI video is already uploaded on the YouTube, so please go through that. AMT I will take, net investment income, self-employment, taxes, household. Tomorrow we'll complete all these taxes. Then we'll do some filing consideration. Let's do the estimated tax today only, guys. Estimated taxes, I think it's a smaller topic. And in credits, we still have 2-3 credits remaining. Only the adoption credit is left, excess withholding, premium tax and earned income. Rest all credits we have already covered on the first session in the IRA related topic. Okay, so no worries, tomorrow we'll complete almost most of the part. No worries, if needed, we'll keep one more session on Wednesday. Okay, we'll delay the start of the part 2 date by 6th October, but we'll try to complete maximum of the portion by tomorrow. Only few things are left. So please attend tomorrow's session. Maybe it can be a last session. And if tomorrow time permits, I'll just give you a study plan, or I'll just upload it in the group. Okay, so what study plan you need to follow? Based on this revision lectures, your study plan will be there. You have to just go on repeating that study plan again and again. It will be a 7 days plan. use that 7 days. I know many people are having exams on 10th October, 11, 12, 13, 14. I know during the whole October, mid of October, there are exams scheduled by you guys. So please go on repeating that schedule again and again. I'll give you tomorrow. Okay, so thank you guys. Have a good day. We'll meet again tomorrow at 9 a.m. Thank you guys.